Thank you for joining us in another episode of the Dealmaker series. Today, I'm joined by Venkat Jasti. He's an angel investor with Cowtown Angels out of Fort Worth. Venkat, thank you for joining us today. Tell us a little bit about yourself and what you do as an investor.
Yeah, happy to join. Thanks for having me, James. I'm a engineer by degree. Started off my career as a technical lead. Like my actual title was called Scientific Numerical Modeler, which is a handful. And that was with Mackay Ocean Engineering. Spent a decade and a half with them. And through the years, changed my role from technical contributor all the way to top management of the company. And past couple of years, I switched gears a little bit and I have been trying to grow a printed circuit board manufacturing company that makes like flex PCBs for defense and aerospace and medical grade applications, which has been a good learning because it's all the manufacturing space that I'm learning about. And particularly most relevant, like you said in your introduction for this conversation, is the angel investments that I've been doing on my own for the past couple of years. I predominantly work with Cowtown Angels. It's a fantastic group based out of Fort Worth, part of Tech Fort Worth umbrella. So the overarching arc is that I've always been curious. I'm trying to jump from space to space and learn as much. And I'm hoping to use that learnings in selecting and helping startups.
Excellent. I'm glad to have you on here. I don't think I've interviewed an angel investor yet, so this is exciting.
Yeah.
So let's get right to it. What are you seeing as far as deal flow out there? Is there an uptick in deal flow, or has it slowed down this year or this quarter, or what are you seeing?
Yeah, so let me start off by what we've actually funded this year, right? So as part of Cowtown Angels, if I look at the last year or so, what we have been funding is companies that are in somewhere between seed to late seed stage. And I know that these definitions vary quite a bit in terms of funds that they're raising. They're raising anywhere from $1 million to $2.5 million. And the valuations have been somewhere between 8 to 16. And recently we're starting to see them ticking more towards $20 million valuations too. And as a group, we've been mostly focused on, I would say, traction, right? Like some demonstrable piece of information, whether it is like significant publications because you're a deep tech company, or whether it is like early sales because you're a consumer company, whether it is letter of intents because you're in manufacturing space where you already need a lot of investments before you can make them happen. Obviously, purchase orders would be great, but stuff like that. That's what I mean by tractions. And that's what we've been funding. I do have one comment on spaces of deals that we are seeing in, right? I think everyone understands that we are going in some sort of an LLM revolution period. There is this, I almost think of as like two different worlds of like angel investments that are happening right now. There are these VC firms which are reaching down all the way to pre-seed space nowadays and taking bets on like entire sectors, right? So they're like, hey, I have a lot of conviction on this space because there's going to be like some like 1000x company that is going to come in, like, let's say a speech-based customer service, which everyone understands why it can be disrupted, or like legal space, whatever. Like, and they're like funding huge at great velocity and bigger checks too, right? And their model is, hey, I'm just buying a seat at the table so that I can keep an eye on breakthroughs that might happen. And if there is a company that is breaking through, I am buying my right to be the lead investor in the next round and the next round. And I'm more worried about getting returns on those funds, and pre-seats for them are like basically expendable costs to get seat on the table. And meanwhile, there is the rest of the world, which is clean tech, materials, deep tech, hard engineering, traditional consumer products, medtech products. These, I think, are functioning just like, from my understanding, how angel investment has always been done, which is longer due diligence cycles, show me more traction, deals don't close that fast, and so on and stuff, which has been very interesting. Like I was in like the ACA conference, which is a conference of Angel Capital Association, which is angel groups throughout the country meet once a year in Denver. That happened earlier this year, and it was very apparent, like the deal flow or the companies or the groups that showed up significantly missing were people from coasts, like not a significant representation from AI companies and so on. So I hope that gives you a little bit of context on what we are seeing.
So yeah, let's talk a little bit about deal structures. I know in the angel space, you tend to have maybe a handful that you gravitate toward, but shed some light on that. What sort of deal structures are you seeing more frequently here lately?
I mean, founders would obviously want to do safe, which is very easy for them, less legal costs upfront and less commitments, and that's what they would prefer with. If you ask angels, they would all prefer convertible notes because there is some amount of interest components and there's some amount of time pressure put in there, and or priced rounds, which then you know exactly what you're buying for and so on. But I think it has to be done on a deal by deal basis. I see why in some spaces safes are better and in some spaces maybe not. I don't have a strong opinion on one or the other. I almost feel like we are betting at such an early stage that I have my portfolio theory of like 1 out of 8 companies is going to help me return like whatever money that I am going to invest in. So I'm not really one of those investors that is stuck on like which investment vehicle is the most important one, but I do see the point. And I believe like the recent bill that came out has like some QSBS updates and so on. And those also actually tilt the favor towards not doing safes because you have like significant tax benefits that come with. I'm sure like a CPA or somebody else would give a better answer than I would. But from my point of view, I understand all of these and there is slight preferences when we do these deals, but I am more focused on like, what's the founding team? Does this idea make sense? And, can they
Yeah.
actually scale, right? So
Yeah, safes have definitely, I think, risen in the last few years
yeah.
as the preferable structure. That's
So
good
to
to
tie
hear.
your earlier 2 questions, these are all innovations of a Y Combinator world, right? So they are the ones who started the safes, and actually is a perfect example of people taking bets on entire sectors, like I was talking about earlier. So this is what they're built for. They pick a space and they want to deploy as many teams as fast as possible to see like who might get traction.
Yeah, and speaking of taking bets on entire sectors, you kind of touched on this earlier. Are there any sectors or industries that are particularly active that you're seeing here in DFW?
I don't know about the DFW in particular because we invest in all over the. We are obviously we would like to give companies that are based out of Fort Worth, and if I'm speaking for Cowtown, but I'm also part of other syndicates that are focused on ocean engineering, for example, or manufacturing. And obviously those guys focus on their sectors. But I think maybe the comment that I can add is there is a slight improvement of quality of deals, at least that I have seen this year, as opposed to what I would receive last year, because some of these good companies are not getting enough attention because other funds are running after AI space and not giving them as much attention. So that I've definitely seen. So there is like slightly better, more mature companies that are showing up as an individual investor for me to get a chance to invest in them because they're having a relatively tougher time because of the other sectors getting so much traction and absorbing so much cash. That is the other thing. These AI companies are getting so much money out of all these other funds at such a quick pace that there's only net so many investment dollars that are available to invest. And I think the other pressure that they're seeing is these companies are not returning cash faster either. It used to be like 6 to 8 years is when people would expect an exit out of these companies. From my understanding, it is now trending towards like 10, 12 years. So essentially, that means that there is that much cash that is locked up in these companies that is not available for reinvestment, right? So as an LP or as like even like a early employee, and these guys are one of the best founder angel investors that can happen down the line, right? So if I get an exit because I was an early employee in a certain sector, I turn around and some percentage of people are going to become angel investors in their space. And that whole cycle is getting delayed because companies are staying private so much longer nowadays. It's a very interesting
It is. It
phenomenon.
is.
And people should figure out like secondaries or there's got to be some liquidation option that should be provided so that smaller LPs and early stage employees should get access to actual cash faster, in my opinion.
Yeah, interesting. So you're seeing a lot of dollars chasing after the AI space, of course. It's at the top of everybody's mind right now. So it's opening up some of the opportunities in all of the other industries. It sounds like that's an interesting observation there. Are there any that you're gravitating toward? Any industry?
Not because of this particular reason, but in general, because of my background and so on and stuff, I tend to gravitate a lot more towards like hardware and materials and so on and companies just because I love working with those founders. They're usually like a lot more persistent, lot of people compared to everybody else, in my opinion. Probably it's a biased opinion just based on my background, but I like, and it's a harder space in, right? Just because of my background, I have a lot of empathy towards people who are trying to build anything in hardware space because iterations are not free. You can't do like over the air updates. You can't just release cycles are not free. Like if I have to do an update on a product, I actually have to design a new product, manufacture a new product, do the inspection, do the warehouse management, do like a lot of stuff. And then you get like one iteration of learning. Startups are, if anything, in my opinion, startups are basically experiments that you can run as fast as possible in de-risking. And if you think about it, running experiments in hardware is a lot harder thing. So I tend to gravitate towards those, is just my tendency, I guess.
Yeah. Are there any current elements that are impacting deals in that space? Like, are the tariffs impacting there, I imagine, or maybe interest rates or anything else?
They all do, but I keep thinking that this is nothing new for them. They deal with this sort of stuff. Founders in this space understand for the same reason, right? Because a vendor can suddenly switch costs on them. A vendor might suddenly drop in quality because they have had some employees change. This is such a reproducibility in hardware is also another point that I want to touch on, right? So you make a software, making a copy of the next, you can sell as many licenses you want. Reproduction cost is almost next to nothing. But in hardware, it's a continuous game, right? So you order a lot of parts. You have no idea when the next one comes around if it still meets the same quality or not. Something must have changed on your vendor side. So, anyways, my point is, yes, tariffs are greatly affecting it. But at the same time, I don't think the founders in this space are like that scared because of it, because they have been dealing with issues like this in the past. Maybe it was not tariffs, it was something with vendors. They've increased prices, or some other supply chain disruption, or somebody closed the port because of COVID, or whatever the deal was. They've been
Yeah,
dealing with this for a while. So they're probably resilient enough to figure this out.
that's good to hear.
Yeah.
Well, let's shift a little bit more to our geography here in DFW.
Mhm.
Is there anything unique about the DFW market, or maybe Texas versus others?
I think so. I think that was a good question. And I was thinking about it quite a bit. And I think the advantage that we have as DFW is we have a huge concentration of Fortune 500, small, medium sized businesses, mom and pop stores as well, right? So there is a big market. And so any solution that requires like working with your like first cohort of clients where you can co-develop with, I think we have an advantage. And I think now that I think back, this has been true for like some section of SaaS companies that are in business to business space that have actually taken advantage of being in DFW. And I don't see why this should change in like, let's say, all the AI companies that is coming forward. And if you then expand it to Texas overall and Dallas Fort Worth as well, but Texas overall, there's a lot of manufacturing chops as well, right? So if you are like in, like, again, to my earlier questions, if you're in hardware space or material space, what you want is pilots with some of these bigger companies and you're closer to them in proximity. So that's a huge advantage in my mind. Now, those companies are also changing, which is another good factor for us, because big companies, as we know, take a long time to make any changes. This has been proven. But I
Right.
think they're also feeling the pressure of like the exponential age that we're living in, right? So they're all trying to change, ramp up to AI wave that is happening. And not many people think about it, but behind the AI wave is like a few other things that are happening, right? So there's huge progress that is happening in robotics space. There is progress that is happening in personalized medicine space. There is hopefully AI derived benefits that happen in discovering new materials. And all of this stuff is going on. So even these big companies are realizing that, hey, I need to be able to respond much more quickly than we've ever done in our past history. And I think they're looking more and more towards startups to, be that source, right? So they know that they don't have a team set in place because of all the factors in a classic innovator's dilemma factors, that they might not be the ones that will disrupt themselves. But they are setting almost like skunk work like teams inside their big companies where they're like, hey, your mandate is go find out all the startups in my space and set up pilots so that we'll learn what we'll, and maybe we'll potentially acquire them. So we should take advantage of that. That's my hope.
Yeah.
Mhm.
Interesting. Interesting take for DFW. It sounds, the consensus I've picked up this year interviewing folks is definitely that DFW is a new epicenter for business and investment, whether
Yeah.
it's Fortune 500 or at the startup level. So
Yeah.
that's exciting to hear for sure. So, all right, last question, and we'll take out the crystal ball here, and we're going to look into the future. What do you see coming next as a major shift in the investing space, startup, large business, DFW, whatever you think? What do you see coming?
So this is something, I mean, there's different dimensions, directions we can go in, but maybe I'll pick like the founder side of things, because at the end of the day, the founders have to create the companies for angels to do anything on top of it. And what I've changed my mind recently is about the weightage that I put for, technical execution chops to the passion and like importance to the problem and meaningfulness on why they want to tackle certain problem. Because for the just to tie into the previous question, right? Because the LLMs give access to intelligence to everybody now, and there's so many more execution things that are coming in. You can build websites easily, you can find customers easily, you can get access to this. So the technical details that I used to be fixated on, right? Like in the previous we used to be like, oh, who's your technical co-founder? That used to be like a very important question to everyone. I'm leaning less and less towards asking that question, because I'm thinking that, hey, the better question going forward is like, why are you uniquely as a founder or as a founding team the best people to tackle this problem? Have you grown up with frustration of this problem for a lot longer? It's like personally frustrated you. How passionate are you about this? Is like a little bit more indexing towards that nowadays, because I think everything's going to get easier as this exponential age pans out, right? Everything becomes easier to make. Authenticity on why are you the person that should be tackling this problem, I think should be weighted more. A lot of flux happening, right? So we are living
Yeah.
in like a very high rate of change environment. So this might change, but right now that's my thought
Yeah.
process.
Interesting shift.
Mm.
Venkat, I appreciate your time. I appreciate the insights. For those of you watching, I hope you find this as useful as I do. To find more episodes of the Dealmaker series, visit my YouTube channel and follow me on LinkedIn. Venkat, thank you, sir. I appreciate it.
Yeah, thank you, James. It was great.